The dollar is not disappearing tomorrow. That is not the real story. The real story is more subtle. And because it is more subtle, it is more dangerous for investors who are not paying attention. The world is not moving from one system to another in a single dramatic moment. It is not like a light switch. It is more like a tide. At first you barely notice it. Then one day you look back and realize the shoreline has changed. That is what is happening to the global financial order. For most of my life, the United States dollar has been the center of the global system. It was the asset countries trusted, the currency central banks held, the unit used to settle trade, the safest harbor in crisis, and the foundation underneath the modern investment world. That system did not happen by accident after World War II. The United States emerged with the strongest economy, the deepest capital markets, the most powerful military, and the most trusted institutions. The dollar became the world's reserve currency because the world needed a stable center, and the United States was that center that gave America an extraordinary privilege. It meant the United States could borrow cheaply, it could run deficits more easily, it could print more money than other countries could get away with. It could finance its government, its military, its innovation, and its consumption with the knowledge that the rest of the world still needed dollars. Other countries held dollars. They bought treasuries, they traded in dollars, they settled energy contracts in dollars, they saved in dollars. That created a powerful feedback loop. The more the world needed dollars, the more powerful the dollar became. The more powerful the dollar became, the easier it was for the United States to finance itself. The easier it was for the United States to finance itself, the larger the American financial system became. And the larger that system became, the more the world needed to stay inside it. That was the old machine. But all machines change when incentives change, and the incentives have changed. The dollar is now having one of its weakest periods in decades. Oil prices are rising, inflation risk is returning. Stagflation risk is being discussed again. China is becoming more important in global trade. BRICS nations now represent a much larger share of the world economy by purchasing power. Central banks are buying gold. Countries are experimenting with payment systems that bypass the dollar. Major institutions are starting to forecast lower U.S. returns and better opportunities internationally. Most people see these things as separate headlines. They are not separate. They are connected pieces of the same larger shift. When I think about this as a system, I do not start by asking whether the dollar is finished. That is the wrong question. The right question is the dollar's dominance being diluted? And the answer is yes. Dilution is not collapse. That distinction matters. A collapse is fast, dramatic, and obvious. Dilution is slower, harder to see, and easier to ignore. Collapse makes people panic. Dilution makes people complacent. But for investors, slow dilution can reshape returns for a very long time. The dollar does not need to lose its reserve currency status overnight to change your portfolio outcomes. It only needs to lose enough marginal demand to change the flow of global capital. That is what we are beginning to see. For many decades, it made sense for other countries to hold US dollars and US treasuries. Dollars were liquid, accepted, stable, and backed by the deepest markets in the world. But once the United States froze Russia's foreign reserves after the invasion of Ukraine, every country outside the closest US alliance had to ask a new question. Could that happen to us? Whether you think the action was justified is not the point for investors. The point is that it changed the calculation for other countries. If you are a country that may one day be in conflict with the United States, or may one day need to act independently of US policy, you begin to think differently about holding all your savings in a system controlled by someone else. That does not mean you sell all your dollars at once. That would be irrational and self-destructive. It means you diversify slowly, you buy more gold, you settle more trade in your own currency, you build alternative payment rails, you reduce the share of reserves held in US treasuries, you create options. That is how world orders change, not through speeches, through incentives. China is one of the clearest examples. Years ago, China held a very large portion of its reserves in US treasuries. Over time, that share has declined. China has also built its own cross-border payment system and has encouraged settlement in yuan where possible. This does not mean the yuan is replacing the dollar tomorrow. It does not have to. The goal is not necessarily replacement. The goal is optionality. If a country can settle more trade outside the dollar, hold more reserves outside the dollar, and reduce vulnerability to dollar-based sanctions, it has changed its risk profile. The same logic appears in bilateral trade settlements, where countries trade in their own currencies rather than routing everything through dollars. It appears in central bank gold purchases. It appears in BRICS payment discussions. It appears in experiments with digital settlement systems among countries that want to reduce dependence on Western-controlled infrastructure. Some of these systems are early, some may fail, some may take years, some may never become large enough to replace the dollar, but replacement is not the threshold. Erosion is the threshold. If enough countries use the dollar a little less, hold treasuries a little less, settle trade in other currencies a little more, and diversify reserves a little more, the old system becomes less dominant. That is the important point. You do not need a new empire to destroy the old privilege. You only need enough fragmentation to make the privilege less absolute. This is why the phrase changing world order matters, even though it is often abused. A changing world order does not mean the world ends. It means the hierarchy of power, trade, money, and returns shifts. Every major shift in world order creates both wealth destruction and wealth creation. The people who are over-concentrated in the old system tend to assume the old system will continue forever. The people who study the transition can protect themselves and position for the new opportunities. That is the lens I want you to use. Not panic, not ideology, not anger. A clear understanding of cause and effect after World War II. The United States controlled a huge share of global output and designed the financial architecture around the dollar. That architecture gave American investors enormous advantages. U.S. stocks became the default asset. The S&P 500 became the great engine of household wealth. The U.S. technology sector became the center of innovation and equity returns. That was real, it was not luck. The United States had the best ecosystem in the world for capital formation, entrepreneurship, innovation, military protection, property rights, and liquidity. But the question for the next decade is not whether America was dominant in the last century. The question is whether the return from being heavily concentrated in America will be as strong in the next decade as it was in the last few decades. That is a different question, and the major institutions are beginning to answer it differently. Vanguard, J.P. Morgan, Fidelity, and others have been pointing toward a future in which U.S. equity returns may be lower than investors became used to, while international and emerging markets may offer better relative opportunities. These forecasts will not be perfectly right. Forecasts never are. But they are signals. And when several serious institutions start making similar observations from different angles, I pay attention. One reason is valuation. The U.S. market is expensive relative to many international markets. The largest companies dominate the index. The top 10 names represent a very large share of the S&P 500. That concentration has helped investors when those companies performed well. But it also creates risk. If a small number of mega-cap stocks carry the market, the index is less diversified than people think. People believe they own 500 companies. In practice, a large part of the result is driven by a small group of giants. That can work for a long time, but it means future returns depend heavily on whether those giants can keep delivering exceptional growth from already large bases and high valuations. Another reason is the dollar. If the dollar weakens over time, foreign assets can benefit us investors when translated back into dollars. A foreign stock can generate the same local currency return, but if the dollar declines, the US dollar return can be better. That is not a reason to abandon the United States. It is a reason to think globally. The world is getting bigger, not smaller. India is rising. Its population is enormous, young, and increasingly technologically capable. Emerging markets are expected to become a much larger share of global market capitalization over time. China, despite its problems, remains a massive economic force. Other countries are growing their consumer bases, manufacturing bases, financial systems, and technology ecosystems. The United States can remain powerful while other countries become more important. That is how relative dominance changes. It is not that America becomes irrelevant. It is that America becomes one of several major centers rather than the singular center of everything. That is what I mean by dilution. The old world was dollar-centered and US-centered. The new world may still include the dollar and the United States at the core, but with more weight shifting toward other regions, other currencies, other payment systems, other asset classes, and other sources of growth for an investor. The mistake is to treat this as a political debate. It is not about cheering for one country over another. It is about protecting purchasing power and allocating capital rationally. If your entire life is in one country, your job, your home, your currency, your bank, your retirement accounts, your stock portfolio, your bonds, and your future spending, then you have more concentration risk than you may realize. Many American investors already earn in dollars, spend in dollars, own a home priced in dollars, hold bank deposits in dollars, own U.S. stocks, own U.S. bonds, and rely on U.S. policy. Then they say they are diversified because they own the S&P 500. That is not full diversification. That is concentrated exposure to one system, even if that system has been the best system for a long time. In investing, the greatest risk often comes from the thing that has worked so well that nobody questions it anymore. For many Americans, that thing is us exceptionalism expressed as portfolio concentration. I am not saying the United States is finished. I am saying that assuming the United States must outperform forever is not a principle. It is a belief, and beliefs should be tested against changing reality. There is another layer to this. National debt continues to rise. Deficits remain large. Governments often find it easier to print, borrow, and inflate than to impose discipline. Over long periods, that weakens the purchasing power of currency. This is not unique to the United States. It is a recurring pattern in history. When countries have the reserve currency, they gain privilege over time. That privilege can encourage excess. The excess creates debt. The debt creates pressure. The pressure leads to money creation, political conflict, and eventual adjustment. It does not always happen quickly, but it happens through a recognizable cycle. This is why I pay close attention to debt, currency, reserve status, and the balance of power. These are not abstract topics. They shape asset returns. A country can remain strong and still deliver lower investment returns if valuations are too high, debt is rising, and capital begins to diversify elsewhere. A country can have problems and still offer attractive returns if valuations are low, growth is high, and capital inflows improve. Investing is about price relative to future outcomes, not just quality. America is high quality in many ways. It still has the deepest capital markets, the best technology ecosystem, leading universities, venture capital, innovation, artificial intelligence, semiconductors, biotech, and military strength. In crisis, money still often runs into the United States because there is no equally liquid and trusted alternative. That is why I do not believe in a sudden dollar collapse as the base case. The dollar is still used in a huge share of foreign exchange transactions. It is still central to global payments. Alternative systems are developing, but many still remain small, incomplete, or indirectly connected to dollar infrastructure. Europe has political and debt problems. China has capital controls and trust issues that make the yuan difficult to use as a true reserve currency. Gold is useful as a store of value, but it is not a modern payment system by itself. Bitcoin may be important to some investors, but it is too volatile to function as the main reserve asset for global trade in the near term. So the dollar still has enormous strengths, but this is exactly why the issue is dilution, not collapse. The dollar can remain the most important currency and still lose some share. The United States can remain the most important market and still underperform relative to other markets from this valuation starting point. Both can be true. A thoughtful investor must be able to hold two truths at the same time. America is still powerful. America is not guaranteed to dominate returns forever. That is the balance. Now we can think about what to do. The first principle is not to go all in on one country. If all your assets are tied to the United States, you are making a bet. Maybe it will work. It has worked beautifully for a long time, but you should know that you are making it. The question is not whether the United States will remain important. I believe it will. The question is whether you are being paid enough to accept full concentration risk at a time when valuations are high, debt is high, and the world is becoming more multipolar. Diversification is not an admission that America is failing. Diversification is an admission that the future is uncertain. That is the entire purpose of diversification. You do not diversify because you know exactly what will happen. You diversify because you do not. That means owning some international exposure can make sense. For many people, a simple international index fund can do the job. It does not have to be complicated. You do not need to become an expert in every country. You do not need to pick the exact winning market. You simply need some exposure to growth outside the United States. Emerging markets are especially important in this discussion because they start from lower valuations and have more room to grow. Their demographics, productivity gains, urbanization, consumption growth, and technology adoption can create long-term opportunities. That does not mean emerging markets are safe. They are not. They can be volatile. They can have political risk, currency risk, governance risk, and liquidity risk. Some countries will disappoint. Some will mismanage their finances. Some will suffer from corruption. Some will experience severe drawdowns. But over a long period, owning a diversified basket of emerging markets may be very different from betting on one country. The key is sizing. You do not need to move everything. You need to build resilience. There is a big difference between diversification and overreaction. The second principle is to consider assets that benefit from currency debasement and changing world order dynamics. Gold is one of those assets. I have never believed that gold is a perfect asset. It does not produce earnings. It does not innovate. It does not pay dividends. It sits there. But sometimes sitting there is the point. Gold is outside the liability structure of any single government. It cannot be printed by a central bank. It is treated by many countries as a neutral reserve asset. When central banks buy gold aggressively, they are sending a message about trust, currency risk, and geopolitical uncertainty. That does not mean you put all your money in gold. That would be another form of concentration. But a small allocation can function as a hedge against monetary disorder, dollar dilution, and geopolitical fragmentation. The third principle is commodities. If emerging markets grow and the dollar weakens, commodities can become more important. Oil, metals, copper, food, and other resources are not abstractions. They are the physical inputs of the world economy. When supply chains are stressed, when inflation rises, when governments spend heavily, when emerging markets industrialize, and when the world order changes, commodities can act as a form of insurance. Again, this should be sized carefully. Commodities are cyclical, they can be volatile, they can have long periods of poor returns, but in a portfolio built for a changing world order, having some exposure to real assets can reduce dependence on financial assets priced in one currency. The fourth principle is not to abandon the United States. This is very important. Some people hear dollar dilution and immediately go to extremes. They think they must sell everything American, buy only gold, buy only foreign markets, or hide in alternative assets. That is not rational. The United States still has major advantages. It has the deepest capital markets, it has a powerful innovation ecosystem, it leads in artificial intelligence, semiconductors, software, biotech, venture capital, and many of the world's most profitable companies, even if expected returns are lower than before. Lower does not mean negative. And if the US continues to innovate, it can still compound wealth. The point is balance, not abandonment. A good portfolio can hold us equities, international equities, emerging markets, some real assets, some gold, maybe some carefully sized alternative exposure, and enough liquidity to stay flexible. The exact mix depends on the person, but the principle is universal. Do not build a portfolio that only works if the last 20 years repeat. That is one of the most dangerous habits in investing. People project the recent past into the future because the recent past feels like reality. But markets move in long cycles. Leadership changes, currencies change, valuations change, capital flows change. The next decade does not have to look like the last decade. If the US continues to dominate, a diversified investor still benefits from the US exposure they own. If the US underperforms and international markets do better, the diversified investor has something to fall back on. That is the beauty of a balanced approach. You do not need to know the future perfectly. You need to be positioned so that more than one future is survivable. The fifth principle is flexibility. The world order is not changing in a straight line. It will move in waves. There will be moments when the dollar strengthens because fear pushes capital into its assets. There will be moments when de-dollarization looks overhyped. There will be moments when emerging markets disappoint. There will be moments when gold pulls back. There will be moments when U.S. technology stocks roar higher again. That is normal. Transitions are messy. If you expect a clean line, you will be shaken out. A changing world order is not a one-year trade. It is a decade-long adjustment. That means the right response is not to make one dramatic move. It is to gradually adapt. Small adjustments today can make a very large difference over 10 or 20 years. This is one of the most important truths in compounding. You do not need to change everything at once. A small shift in allocation maintained for a long time can materially change your outcome. If you are 100% U.S. stocks, maybe you gradually add international exposure. If you have no emerging markets, maybe you add a modest allocation. If you have no real assets, maybe you consider a small position in gold or commodities. If you have no liquidity, maybe you build some. If your portfolio is built entirely around one assumption, maybe you add assets that perform under different assumptions. That is not fear, that is prudence. The people who do best in changing systems are not usually the people who make the most dramatic predictions. They are the people who build portfolios that can handle several paths. Now let us return to China. The phrase China is dumping the dollar sounds dramatic. It attracts attention. But the more accurate explanation is that China and other countries are reducing dependence on the dollar over time. That is less dramatic, but more important. A sudden dumping of dollars would damage China too, because China still holds dollar assets and depends on global trade. Major countries do not usually destroy systems they still use unless they have no choice. Instead, they build alternatives slowly. They reduce treasury holdings as a share of reserves, they sign trade agreements in local currencies, they increase gold reserves, they build payment systems, they encourage settlement outside the dollar where possible, they make sure that if conflict comes, they are less exposed than they were before. That is strategic behavior. And once one country does it, others begin to ask whether they should do it too. That is how the network effect weakens. The dollar's strength came from a network effect. Everyone used it because everyone else used it. But if enough players create alternatives, even partial alternatives, the network becomes less absolute. This is a slow process, but slow does not mean irrelevant. For an investor, the most important effects may show up through asset prices rather than a headline announcement. Lower marginal demand for treasuries can affect rates. Dollar weakness can affect imported inflation and foreign asset returns. Gold demand can affect precious metals. Emerging market growth can affect equity leadership. Commodity demand can affect inflation hedges. U.S. valuation compression can affect expected returns. These are portfolio questions. That is why this matters to ordinary investors. It is not because you need to predict the exact future of BRICS Pay or mBridge or any single digital settlement system. Most of those systems are uncertain. Some may remain small, some may be blocked by trust issues, some may be technically impressive but financially limited. The point is that the desire to bypass the dollar is growing. In systems thinking, desire matters because it changes behavior. Behavior changes flows. Flows change prices. If capital flows begin to diversify, portfolios should too. Now consider India. India may be one of the most important pieces of the next long cycle. It has a very large population, favorable demographics relative to China, growing technology adoption, and the possibility of becoming a much larger share of global GDP and equity markets. Of course, India also has risks. Every country does. There are valuation risks, infrastructure challenges, policy risks, and execution issues. But the direction of the opportunity is important. A young, growing, increasingly digital population can create decades of compounding if institutions, infrastructure, and capital markets continue to develop. If investors remain overwhelmingly concentrated in the United States, they may miss some of that. That does not mean India replaces America. It means the global opportunity set broadens. This is the central idea. The world is becoming more multipolar. A multipolar world means more than one center of economic gravity, more than one growth engine, more than one currency system, more than one strategic bloc, more than one place where capital can compound. That creates complexity. It also creates opportunity. The old portfolio answer was simple: buy U.S. stocks, especially the S&P 500, and let the greatest market in the world do the work. That may still be a good part of the answer, but it may no longer be the whole answer. And when the whole answer changes, investors who adapt early have an advantage. This does not require being brilliant. It requires being honest. Honest about debt, honest about valuations, honest about concentration, honest about currency risk, honest about the fact that no country stays at the peak of relative dominance forever without some form of challenge, honest about what has worked, and honest about what may not work as well. A good investor does not need to be patriotic with every dollar. A good investor needs to be realistic. You can love your country and still diversify your portfolio. Those are not opposites. One is identity, the other is risk management. Now, there is a psychological trap here. Because the U.S. market has done so well, investors feel that anything outside the United States is inferior. They look at past returns and assume the future will match them. They see foreign markets underperform and conclude that underperformance is permanent. But returns are cyclical. The best performing asset of one period is often not the best performing asset of the next period. High valuations pull forward future returns. Low valuations, when combined with improving fundamentals, can create better future returns. That is why the institutional forecasts matter. They are not saying international markets are perfect. They are saying the starting conditions may be more attractive. Starting conditions are very important if you buy an excellent asset at too high a price. Future returns can be disappointing if you buy a decent asset at a very attractive price. Future returns can be strong. The United States has many excellent assets. The question is the price. International and emerging markets have many imperfect assets. The question is whether the price compensates you, that is investing. Now let us think about the dollar itself. The dollar has problems, but every alternative has problems too. This is why the transition is likely to be slow. Europe has fragmentation and debt issues. China has capital controls, demographics, property problems, and a political system that makes many global investors cautious. Gold cannot support the full volume and speed of modern trade settlement. Bitcoin is volatile and not yet a stable reserve unit for governments. BRICS countries do not all trust each other equally. Alternative payment systems face scale, liquidity, governance, and adoption issues. So the dollar remains dominant because the alternatives are not yet strong enough. But dominance can decline without disappearing. Imagine a company with 70% market share. If it falls to 55%, it is still the leader. But the economics can change. The pricing power can change. The growth rate can change. The valuation can change. That is the right analogy. The dollar can remain number one while losing some of the extraordinary privilege that allowed the United States to finance itself so easily. That matters for interest rates, inflation deficits, and asset allocation. This is why investors should not frame the decision as dollar collapse or nothing. The more likely scenario is a long period of relative decline, intermittent dollar strength, ongoing US innovation, rising foreign competition, more regional payment systems, more gold demand, more commodity sensitivity, and more diversified global capital flows. In that world, the best portfolio is not extremist, it is balanced. It keeps us exposure because the United States remains powerful. It adds international exposure because other regions may grow faster from lower valuations. It owns some emerging markets because the center of population and economic growth is shifting. It owns some real assets because currency debasement and supply shocks are real risks. It may own some gold because central banks are signaling a desire for neutral reserves. It avoids being over-leveraged because transitions can be volatile. It remains flexible because the path will not be smooth. That is a much better response than fear. When I hear people say the dollar is dying, I want to slow them down. Currencies do not usually die in the way social media describes. They weaken, lose share, inflate, get challenged, and adjust. The process can take a very long time. But when I hear people say nothing is changing and the dollar will dominate forever exactly as before, I want to slow them down too. That is complacency. The truth is in the middle. The dollar is still strong. The dollar is losing some dominance. America is still powerful. The rest of the world is becoming more important. U.S. markets are still essential. International diversification is becoming more valuable. That is the practical truth. The investor who can hold that balance will make better decisions. The investor who needs a dramatic story will either panic or ignore the risk. Now we have to talk about behavior because even the right allocation can fail if behavior is wrong. If international markets underperform for 2 years, will you abandon them? If gold falls after you buy it, will you say the thesis was wrong? If the dollar rallies in a crisis, will you forget the long-term dilution trend? If U.S. tech stocks outperform again, will you go back to 100% America? If emerging markets become volatile, will you sell at the bottom? These are not small questions. A strategy is only useful if you can live with it. That is why sizing matters so much. If you size an allocation properly, you can hold it through volatility. If you size it emotionally, you will abandon it when it becomes uncomfortable. A small, thoughtful allocation to international markets held for a decade can be more powerful than a large impulsive allocation sold after one bad year. A small gold position held as insurance can be useful. A giant gold position bought in fear can become a psychological burden. A commodity allocation can hedge certain risks. Too much can create volatility you are not prepared for. The principle is balance. Balance is not weakness. Balance is a recognition that the future is uncertain and that survival matters. Ray Dalio often talks about building an all-weather approach, and the deeper idea is not that there is one perfect portfolio. The deeper idea is that different environments reward different assets. Growth up, inflation down is one environment. Growth down, inflation up is another. Growth up, inflation up is another. Growth down, inflation down is another. A portfolio concentrated in one country, one currency, and one asset class is making a strong bet on one kind of environment. A more balanced portfolio gives you more ways to survive. That is increasingly important in a changing world order. Now, if you are an American investor, the simplest mistake is to think that because you live in America, your portfolio must be overwhelmingly American. Your life is already American in many ways. Your income, home, taxes, healthcare system, political risk, and currency exposure are already tied to the United States. Adding some foreign assets may not make you less secure. It may make you more secure because it gives you exposure to parts of the world that are not perfectly tied to the same risks. The second mistake is to think that diversification means giving up returns. Sometimes diversification reduces returns in a period when one asset dominates. That is true. If you diversify away from the winner, you will lag the winner. But the purpose of diversification is not to always beat the best performing asset. The purpose is to avoid being destroyed by being overexposed to the asset that stops winning. That is a very different goal. For many investors, not being destroyed is more important than maximizing every upside moment. Long-term compounding requires staying in the game. Staying in the game requires humility. Humility means admitting that you do not know whether U.S. stocks will dominate the next decade the way they dominated the last one. You do not know whether the dollar will remain as strong. You do not know whether emerging markets will finally outperform. You do not know whether gold will be needed. You do not know whether inflation will become a larger problem. So you build a portfolio that does not depend on knowing. That is the point. The old world rewarded investors who concentrated in the United States and trusted the dollar. The next world may reward investors who keep that exposure but add resilience. That is not a radical shift. It is an adjustment. But small adjustments made early can compound into very large differences. This is how major transitions usually reward investors. Not through one perfect prediction, through a series of sensible adaptations. If you recognize that the dollar's share of reserves has declined, you do not need to panic. You ask how much dollar exposure you have. If you recognize central banks are buying gold, you do not need to become a gold maximalist. You ask whether you have any hard asset hedge. If you recognize emerging markets are expected to become a larger share of the world market, you do not need to buy every emerging market stock. You ask whether your portfolio reflects the future global economy or only the past one. If you recognize U.S. valuations are high and index concentration is extreme, you do not need to abandon the S&P 500. You ask whether your U.S. allocation is sized rationally. That is how serious investors think. They do not worship forecasts. They use forecasts as inputs. They do not chase every theme. They ask whether the theme changes probabilities. They do not need certainty. They need enough evidence to make a prudent adjustment. And the evidence is building that the next decade may be more global, more multipolar, more inflation sensitive, and less forgiving of U.S.-only portfolios. This is not a reason for fear. It is a reason for preparation. The biggest opportunity of the next decade may not be one stock or one country. It may be recognizing that the world itself is becoming broader and positioning before the average investor realizes that the old assumptions have changed. Most investors will notice only after the returns have already shifted. They will notice when international markets have already outperformed. They will notice when gold has already moved. They will notice when the dollar has already weakened. They will notice when emerging markets are already expensive. They will notice when U.S. valuations have already compressed. That is how crowds work. They wait for confirmation, then pay a higher price. The better approach is to study the structure before the price fully reflects it. That does not mean rushing. It means gradually building the kind of portfolio that makes sense if the world order continues to change. So I would frame the whole issue this way. The United States is not collapsing. The dollar is not vanishing. China is not instantly replacing America. BRICS is not magically building a perfect alternative tomorrow. But the old dollar-centered world is becoming less absolute. That is enough to diversify, enough to own some international exposure, enough to consider emerging markets, enough to respect gold and commodities as hedges, enough to avoid assuming that the last decade's U.S. returns will repeat, enough to keep the United States but not worship it, enough to build a portfolio for more than one future. If the United States continues to lead, you still participate. If the dollar weakens, you have protection. If emerging markets rise, you have exposure. If inflation returns, you have some real assets. If the world fragments, you are not trapped in a single system. If nothing dramatic happens, you are still diversified. That is the beauty of a well-reasoned adjustment. It does not require disaster to be useful. It simply reduces dependence on one outcome. The investors who understand this shift will not be the loudest. They will not necessarily be the ones making the most dramatic predictions. They will be the ones quietly rebalancing, quietly adding exposure, quietly preparing for a world where money, trade, and power are more distributed. That is how smart capital often moves slowly at first, then visibly, then all at once in the prices. By the time everyone agrees, much of the opportunity may be gone. That is why I want to be early, but not extreme. Early means understanding the trend before it becomes obvious. Not extreme means not betting everything on one version of the future. That is the balance that keeps you rational. When I look at this dollar shift, I see risk and opportunity. The risk is that investors who are entirely concentrated in U.S. assets may earn lower returns than they expect, especially if valuations compress, the dollar weakens, and global growth leadership broadens. The opportunity is that international and emerging markets, precious metals, and commodities may become more important parts of a resilient portfolio. The goal is not to predict the exact year China overtakes the United States in any one measurement. The goal is not to know whether India reaches a specific GDP milestone by a specific date. The goal is not to guess which BRICS payment system becomes most successful. The goal is to understand the direction of travel: more multipolar, more diversified, more skeptical of dollar dependence, more demand for neutral reserves, more global competition, more opportunity outside the U.S., more need for resilience. Once you see that, the actions become straightforward. Do not put every egg in the U.S. basket. Do not ignore emerging markets. Do not dismiss gold when central banks are buying. Do not ignore commodities in a world of supply shocks and inflation risk. Do not abandon America because America still has unmatched strengths. Do not panic. Do not overreact. Do not treat diversification as a one-time event. Build a system you can hold. That is the most important part. The future will not unfold exactly as anyone predicts. It never does. Some of today's fears will be exaggerated. Some of today's risks will be underestimated. Some alternatives to the dollar will fail. Some will grow. The U.S. will have good years and bad years. Emerging markets will have booms and crashes. Gold will frustrate people. Commodities will cycle. Technology will surprise everyone. So you need a portfolio that can breathe, a portfolio that can take in new information, a portfolio that can benefit from us innovation and global expansion, a portfolio that is not dependent on one currency remaining uniquely dominant forever. That is the practical lesson. The dollar gave the United States an extraordinary advantage for a long time. That advantage is not gone, but it is being questioned more seriously than before. Other countries are learning that dependence creates vulnerability. They are building alternatives. They are buying gold. They are settling more trade outside the dollar. They are preparing for a world where the U.S. is still powerful but not unchallenged. Investors should do the same. Prepare for a world where the United States remains important but not alone. Prepare for a world where the dollar remains useful but less dominant. Prepare for a world where returns come from more places. Prepare for a world where diversification is not optional but necessary. That is not pessimism, it is realism. And realism is one of the most valuable assets an investor can have, because the market does not reward what you wish to be true. It rewards understanding the world as it is changing. The world is changing, the dollar is being diluted, China is reducing dependence, BRICS is building alternatives, central banks are buying gold, institutions are lowering us return expectations, emerging markets are becoming harder to ignore. The U.S. remains powerful, but the global balance is shifting. You do not have to be afraid of that, but you should not ignore it. The people who protect and grow wealth through these transitions are the people who see the change early, make measured adjustments, and let time work. They do not need to time everything perfectly. They just need to stop assuming that yesterday's dominance guarantees tomorrow's returns. That is the key. The old system made many investors wealthy. The new system may make a different kind of investor wealthy. One who is global, balanced, flexible, patient, and clear-eyed. That is how I would approach it. Not with panic. Not with predictions that sound certain, not with an all-in bet against America, but with a portfolio that respects the fact that the world is no longer as simple as it once appeared. The dollar is still here, America is still strong, but the shift has started, and the investor who understands that shift before it becomes obvious may have one of the biggest opportunities of the next decade.